Hey, tax students. My name is Patrick,
I'm Owen.
and today we're presenting on tax incentives for startups and their effectiveness.
All right, let's kick things off with a little introduction. Startups today operate in an environment full of uncertainty, with limited funding, small teams, and a lot of risk. In the early stages, even small tax savings can make a big difference for startups, and that's why tax incentives can really make or break a business's ability to get off the ground and grow. The IRS actually recognizes this challenge for small businesses, and they offer targeted tax provisions through the IRC code, specifically designed to help small businesses. These incentives are meant to reduce financial barriers, encourage innovation, and help entrepreneurs turn their ideas into real functioning businesses. In this presentation, we're going to break down the specific parts of the tax code that are most relevant to startups. That includes sections 179, 195, 1202, and 41. Those don't make sense now, but we'll get into all that. And along with this, key court cases and IRS guidance that show how these laws are applied in the real world. We'll also look at what kinds of deductions and tax benefits are actually available to businesses in their early stages, before they're profitable or even before they're operational. Finally, we'll clarify the differences between things like deductions, credits, exemptions, and deferrals, because understanding how each one affects your taxable income is key to making informed financial decisions if any one of you become a small business owner. By the end of this, you'll have a clear view of how the tax code doesn't just collect revenue, it also shapes the way businesses grow, survive, and innovate.
So, what are tax incentives? There are a few different types of tax incentives. There's credits, deductions, exemptions, and deferrals. So, credits are a given amount of money that you can take from your tax payment. So, say you owe $100,000 and you have a $10,000 tax credit. That means you will be paying $90,000 of that $100,000. Tax deductions are a little bit different. Tax deductions will reduce the amount that gets taxed. So say $100,000, you have to, excuse me, you're being taxed on $100,000. You have a $10,000 tax deduction, then you will be taxed on $90,000 of that $100,000. Exemptions are a bit different. These are certain transactions or outlets of income that will be exempt from tax. So certain businesses will be exempt from different types of taxes that other businesses may not be, and especially businesses in their first year of operations will have certain exemptions from these tax burdens that growing or developed businesses will not.
All right, let's talk about why this is such a big deal for new businesses today. Statistically, between 70 and 90% of startups end up failing within their first couple of years. That's a huge number, and one of the biggest reasons for that failure is pretty simple. They run out of money. And so startups often face really large upfront costs just to get off the ground, and most businesses aren't even profitable right away or even maybe for a couple of years. And this is where tax incentives come in. These programs help reduce that initial financial strain where it's the ability to deduct equipment under different sections or tax code that we'll get into later. You can deduct other things like pre-opening expenses under a different section, but once again, those will be explained. And these breaks can make a huge difference in launching a business and making it more affordable and more profitable. Keeping more money in the business during those early stages really can be the difference between a business shutting their doors and staying open for their communities.
So the way you find these deductions, they are internal revenue codes, and we can find them here on the Cornell Law School website. It's pretty easy to find them. You can enter the title, as you can see on the screen, and this section, and then research all about them and find out really what they mean and all the stipulations for each of these. So the first tax incentive that we will be discussing today is the research and development tax credit under Section 41. Um, this credit is specifically designed to reward businesses that start the investment in developing new products and or even improving their existing products um, or their services as well. Um, and these are the core of this business startup. They're exploring, trying to make their product the best it can be, and so the government wants to incentivize that so that they don't they don't hesitate because of the tax burdens that may come from the um, the R&D development costs. So what does it actually do? This R&D credit allows businesses to reduce their tax bill on a dollar for dollar basis. So that means every dollar of credit you claim directly offsets your federal income tax or payroll tax liability. And this is different from a deduction because they are taking this exact amount of money and taking it completely away from their tax payment as opposed to taking it off their taxable income. Um, so for startups that don't have taxable income, the government still makes the credit accessible by allowing it to offset their payroll taxes as well. So startups can elect to apply up to $250,000 of their R&D credit towards their payroll taxes, specifically the employer portion of their Social Security taxes or FICA, and this qualifies them to the startup meet. In order to be qualified, they must meet two conditions. The first is having less than $5 million in gross receipts for the year, um, or have no gross receipts older than 5 years. In other words, it's tailored for new businesses. It recognizes that in the early years, startups are likely to be spending a lot on their R&D costs, but probably aren't making much of a profit quite yet. So what counts as an R&D cost? This is important. It's a lot more than people probably expect. There's activities that include designing new software or creating a prototype or testing materials or improving the internal processes of the software or the company in general. And these expenses may qualify or they may also deduct the employee wages and materials and the supplies consumed in this research and development, and even third-party contractors. Um, oops, I'm gonna get rid of that. So the important thing to know is that documentation is very important, as with every other tax incentive. The IRS places heavy scrutiny on, especially on credit claims, because they are an exact amount of money as opposed to a deduction. Um, and it is essential to keep these records, very detailed records of projects and time logs and invoices and any notes that tie to your research activities, um, that you will be directly claiming tax credit on. Um, you should definitely, I would recommend working with a tax accountant to figure this out, because this documentation is very important and can be penalized if you do it improperly or don't do it at all. But more importantly, you want to document so that you can take these deductions off. So in summary, the R&D credit is very important for taking advantage of young companies and, or excuse me, is very important for young companies to take advantage of, and especially if they're doing innovative work and trying to make the products to the best of their abilities. Um, and so yeah, that's the R&D startup tax credit, and absolutely essential and one of the most important um, tax tax incentives for starting companies.
All right, let's get into Section 195 of the Internal Revenue Code, which deals with startup expenditures for small businesses. And just in general, this is a very important um, topic for very small businesses that might have trouble getting capital at the start. So when a business is just getting started, it often faces a ton of costs before it even opens its doors, and we classify these as startup costs. These can be things from recruiting employees, building a brand, market research, legal fees, or even like state filing fees. And these expenditures that we need to have before starting a business really aren't optional, and they're necessary for a business to get up and running. But here's the issue: under normal tax rules, you can't deduct these costs until your business officially begins operations. But that's where Section 195 comes in. This section of the tax code allows new and small business, or just new businesses, to deduct up to 5,000 of these startup costs right away in the first year of business. So if you're spending money and preparing to launch your new business, Section 195 gives you a little breathing room and helps reduce your financial liability in terms of taxes when cash is pretty tight at the start of a new venture. Now, there are a couple key rules that you need to know about when it comes to Section 195 deductions. First is this deduction only applies to expenses that are incurred before your business begins operations. So once you've actually started selling products or opening your doors, offering services, those costs are then treated differently and they fall under the regular business expense rules, not Section 195. Second, there is a phase out rule. So if your total startup costs go over $50,000, your $5,000 immediate deduction starts getting reduced dollar for dollar. And if you spend more than $55,000, the immediate deduction goes entirely away. And at that point, you have to amortize all of those startup expenses, meaning you spread the deduction out over 15 years or 180 months, which you all probably should know this, but amortization is just another way of saying depreciation, but for a different type of asset. And let me repeat that just because it's important. If you go over $55,000 in startup expenses, you cannot deduct any of it upfront, and you have to stretch it out over time with that amortization that I was talking about. So, how does this actually help startups? That $5,000 might not sound like a lot as we go through some of these other IRC tax codes that might look like bigger numbers, and this one isn't relevant. But for small businesses in their first year, maybe ones that had trouble even raising, a couple $1,000s to get their business, $5,000 is a huge game changer, and it might mean the difference between staying alive and failing, like most other small businesses do. And if you think about someone maybe with like a coffee truck or a boutique, their startup costs may not be huge, but every bit that they can write off up front really helps improve cash flow and lowers what they owe in taxes so they can spend it on their business. And from a policy perspective, Section 195 was created to encourage entrepreneurship. It recognizes that getting a business started is risky and expensive, and that even before making your first dollar, you're already making real investments. So the tax code really tries to reward that early hustle for entrepreneurs. In a few minutes, we'll talk about a tax case that actually ties directly into this section of the tax code. The taxpayers did they spent money and they tried to deduct them on their Schedule C of their business before they had begun operations. But we'll dive more into that later. Section 195 could have helped them if they had handled it differently, but they did not do that, and we'll see how they did handle it. But the key takeaway here is that timing matters. If you're not in business yet, like you haven't started commencing operations, Section 195 is your friend. It's the bridge between investing in your idea and being able to claim real tax benefits. So the bottom line is that Section 195 gives small businesses a modest but meaningful deduction to ease into operations. And it's a smart incentive to help people take that leap into entrepreneurship.
Thank you, Owen. All right, so the next major tax incentive that we'll be discussing is the qualified small business stock exclusion under Section 1202. So this is not just geared towards startup founders, but also toward their investors. So this one is especially focuses on the investors of these startup businesses. It's called the qualified small business stock exclusion because they deduct, or excuse me, they will not be taxed on those first capital gains. 100% of capital gains of the qualifying stock of a small business will be excluded from their taxable income. So it allows for an individual to exclude 100% of these capital gains. That means that if an investor or even a founder sells their shares and after holding them for at least 5 years, they could potentially owe zero federal tax on the gain. So if they hold these stocks for 5 years and then sell them after that, they will owe zero taxes on these shares of the stock. So investors will want to invest in these because they'll know that they will get 100% of the benefits of this stock. So not every company qualifies. There are a few criteria that must be met. The business must be a C corporation, and it must be the stock must be issued after August 10th, 1993. So any startup nowadays will be qualified, or excuse me, any C corporation will be qualified. And sole proprietorships, LLCs, S corporations are not eligible for this. And the stock must be originally issued to the investor. It can't be purchased on the secondary market. And the company must have gross assets of less than 50 million at the time of the stock issuance. And finally, the investor must hold the stock for at least 5 years before selling it. There are no limits to how much gain can be excluded. As of today, the exclusion applies to the greater of $10 million or 10 times the taxpayer's basis in the stock. So if someone invested $1 million, for example, in a qualified startup, they could exclude up to 10 million of the gains, or possibly more if their investment grew more than that. So why does this matter? For startups trying to raise money, Section 1202 is kind of like a secret weapon for them because it gives investors a reason to commit to long-term capital in the business, 5 years, and knowing that the investors will know that their investment in this company will be tax-free, which is huge for any investor. It'll make your company more attractive to investors, of course, just because they won't be taxed when they receive the gains from selling their stock. And this benefit also applies to your own shares, meaning that if you eventually sell your own company, the first several $1 million of the company could be completely guarded from tax. It is very important to plan ahead. This incentive only works if the company is properly structured from the very beginning. So that means that choosing to operate as a C corporation is essential for this tax incentive. And of course, you have to maintain careful records, just like with everything else, and issue the stock in a way that is legal with the IRS guidelines and laws. If you wait too long to get your legal and tax house in order, you might miss that window entirely. So, in short, Section 1202 is rewards the long-term commitment of investors in your company because they know that holding the stock for 5 years will make it completely tax-free, and it's an example of the tax code being used to encourage risk taking because again, investing in a startup company is going to be risky. They have a high chance of failure, but the IRS, the government, wants to incentivize investing in these companies and gives you a tax break so that these companies can be invested in and can get off their feet and really succeed. Um, so again, this this tax incentive is mainly focused on the investors and investing in the company.
Okay, let's dive into section 179 of the IRC code, which is the immediate expense deduction of assets. So to put it simply, the IRC section 179 allows for businesses to immediately deduct the full cost of qualifying property. And this property are things like equipment, vehicles, or software, and you can deduct it as soon as it's placed into service rather than depreciating it over several years. Now, this deduction is available to all businesses rather than just small businesses, but it definitely still helps for startups and small businesses. And it is a massive advantage for a startup that needs to buy like tools or other gear up front, but doesn't want to wait 5 to 7 years to write it off on their taxes. So, for example, if a new business buys a piece of equipment for $50,000 in 2025 and it uses it right away, Section 179 lets them deduct the entire $50,000 that same year, as long as they meet a few key conditions, which I'll get into in a second. Now, let's talk about how this helps. Startups often have limited revenue in their first couple years, and any cash savings that they can create make a difference. Section 179 helps reduce taxable income right away, lowering their immediate tax bill and improving their cash flow, which can literally make the difference between surviving or shutting down their business. As for 2025, businesses can deduct up to $1,250,000 worth of qualifying property. And that's a generous limit, and it means small and mid-sized businesses can really benefit from Section 179. And they can even do this to multiple assets up to that $1.25 million limit. And this limit is increasing every year. In 2024, it was 1.22 million, and in 2023, it was 1.16 million. So now, what makes an asset qualify under Section 179? There are a couple conditions to write off these asset purchases, and the first is that it has to be tangible personal property, which means that it's real and you use it in your course of business, like equipment or machines, software, and some types of vehicles. Second, it must be placed in service during the year that you claim the deduction. So you can't just buy it and then write it off. You have to actually place it into service and use it for your business. And the item also must be new to you. So it doesn't have to be brand new. Like you can buy assets that someone else has used before, but you cannot deduct property that you already owned or that the owner is turning into a business asset. Next, it has to be used for business purposes more than 50% of the time. This is key because if you use a truck for personal errands, half the time it doesn't count. So the asset that you're trying to deduct has to be used in the course of business, and you might have to prove that to the IRS. So record keeping of things that you're using can be very important when trying to prove to the IRS that it is a business asset. And lastly, you cannot use Section 179 deductions on land, buildings, or property used by others. This might be said as like real property, which is just real estate. However, some improvements to non-residential buildings are allowed, like HVAC systems or roofs, possibly qualify as real property under recent updates to Section 179. But one thing to remember is the income limitation. So Section 179 deductions cannot exceed the business's taxable income. So if a small business only makes, say, $40,000 in net profit, it can't deduct $60,000 using Section 179. But it can carry the unused deduction forward to future years. So let's just give a quick example. Imagine a smoothie truck startup business makes a $100,000 in revenue, and they spend $50,000 on a new truck that qualifies under Section 179. If they also had $30,000 in other expenses, here's how that would work. So if they make $100,000, you would subtract $30,000 of regular expenses, and then you would also subtract $50,000 for the truck deduction with the Section 179, which would leave only $20,000 in taxable income, saving thousands on taxes for the small business. So overall, Section 179 is about flexibility and upfront tax relief. It lets small business owners reinvest faster and breathe a little easier in their critical early stages when buying and putting into service new assets. 2 of this presentation is legal cases regarding small business and the treatment of tax cases.
The first case we're going to be talking about today is the Kellett versus Commissioner case. So Kellett was the founder of a new business. He called it Vizala. And before launching the company, he spent over $25,000 in development of his website, infrastructure, and preparing his company to enter the market. He deducted these with the intent to, he made these expenses with the intent to deduct them, knowing that they were obviously business-related expenses, and he would deduct them as ordinary and necessary business expenses under IRC 162, which is the general rule for deducting expenses incurred in the course of business operations. But something he overlooked, and this is why it's so important to study these well and even hire a professional, was that the IRS later ruled that his business hadn't officially began operations at the time that those expenses were incurred. And so in the eyes of the law, Kellett was still in the startup phase, and under IRC 195, startup costs are treated differently, and only the first $5,000 and those startup expenses before the business operations begin can be deducted, and that phased out for total expenses over $50,000, and the remainder is amortized over 15 years. And so the court held that because Vizala had not yet started generating revenue, it hadn't actually began as a company, and it hadn't begun any business activity, that the expenses were pre-operational and were therefore not deductible under Section 162. And so Kellett had to recategorize them under Section 195, and most of his deductions were deferred for over a decade. So the problem here was that the IRS draws a very firm line between the startup expenses of a company and the operating expenses of a company, and you are not allowed to claim deductions for ordinary business costs until the business has officially began. And so it's very important to draw the line of where your business when your business begins, so that you can start treating your business operations differently, and you enter a new phase, an operational phase, rather than a pre-operational phase. So if you're launching a startup, it's very important to document when your business actually begins and when that pre-operational phase ends, so that you don't miss on these amazing tax advantages for startup companies, and you won't have to amortize costs or expenses for up to 15 years. Um, and so Kellett, as I said, had to amortize the rest of his expenses for up to about a decade, and lost a great opportunity to deduct these business expenses under different codes for operating businesses, which he would have been able to do had he um, started his business operations and drew that line of when that pre-operational phase was ending and when his operational and his business actually began.
All right, the next tax case that we are looking at is Eson versus Commissioner. And this happened in 2016. Forgive my pronunciation, but Kwaku Eson and Ashley Reisner planned to start a real estate business, and they went all in, spending about $40,000 on real estate training courses and business cards, as well as branding materials. And they were very serious. They even filed for an S corporation status, which takes a lot of stipulations and paperwork to do. So here is where the trouble begins. By the end of 2016, they had not started operating their real estate business, and they hadn't offered any services or any earned income for, I think it was called Reisner Homes. The business was still in the planning phase at the end of 2016. So they deducted all $40,000. It was more than that actually, but around $40,000 of those expenses on their Schedule C, which flows into their personal tax return. And this deduction would have significantly lowered their personal income tax bill for the year. But the IRS caught this and denied their deduction, citing IRC Code 162, which only allows deductions for expenses when a business is actually operational. So no income, no services, no business equals no deduction. The IRS even tried to penalize them for an accuracy violation under a different code, basically saying that you should have known better. But the tax court did not agree with this decision, and they recognized that Eson and Reisner acted in good faith, even when they misunderstood the rules. So there was no penalty, but still no deduction either for them. So what does this mean for other startups? This case sets a clear precedent for startups and their money that they spend before actually becoming operational. Because planning to do business is not the same as actually doing business in the IRS's eyes. The court said that the startup costs aren't deductible under 162 because Eson's business wasn't active. And those costs could possibly be deducted under Section 195 as startup expenses, but only once the business is operational and earning income, which they were not. So this teaches us that you can't deduct expenses on the Schedule C unless your business has officially started. This means like offering services, generating income, or being like open for business essentially. Second is the intent does not count, the activity does. So just trying really hard to start a business does not mean it's officially up and running, according to the IRS. But good faith does matter for penalties, because if you act honestly and you made a mistake, like the tax court said Eson were, then you might not get hit with a penalty, but you just won't get the deduction for your expenses. Lastly, future founders need to know when they're in business on the day that it happens, because as Patrick said before this, it's a very important decision line in when there are operational expenses versus startup expenses. So the key takeaway here is if you're going to spend money preparing to launch a business, be very careful of how and when you claim those expenses. Until the business is officially active, your expenses fall under Section 195, and that means that they're not deductible right away. They must be amortized over 15 years and only after business operations begin. I think this case is a perfect example of how tax law meets real world entrepreneurship, and even well intentioned people can get tripped up if they don't fully understand what the tax code considers a business.
The next legal case that we'll be discussing now is the Orr. I don't know how to pronounce that. I think it's Orr versus Commissioner. So Orr operated and started a state legal in the state of California, state legal marijuana business, and this case points out how the federal law could sometimes override the state law because Orr ran this cannabis dispensary in California where marijuana sales were perfectly legal, and like any other normal business, he wanted to deduct his operating expenses on his federal tax return, like salaries, rents, marketing costs, and other overhead. But there was one problem, which is that marijuana is still a Schedule 1 controlled substance under the federal law, and that means that it will be treated the same way as like other drugs, heroin or LSD, in the eyes of the IRS. And under IRC 280E, the business that traffic is controlled substances cannot deduct ordinary business expenses, even if those business expenses are legal in the state that the company is operating. So, or then try to get around this by invoking IRC 263A, which allows certain costs to be included in inventory as part of cost of goods sold. He argued that items like depreciation and other overhead could be capitalized and deducted in that way, but the tax court did not allow him to do this, and they ruled that with Section 280E overrides other provisions like 263A. In simple terms, it doesn't matter how creative your accounting is, and if you're in business and selling a Schedule 1 or 2 substance, your federal tax deductions are extremely limited, and that's again because these substances may change in the eyes of state laws, but they do not change in the eyes of the federal laws, and the IRS isn't going to have mercy on your company just because your state laws have changed. And so no salaries, no rent, no advertising, that is not going to be deductible with the IRS. And so startups and the cannabis dispensary are going to have to plan for that dramatically higher effective tax rates for their businesses because they don't have these startup deductions like other businesses do. And most types of deductions are just simply not available to them, not even just startup deductions. And trying to get around the rule usually does not work because the IRS is very serious about controlled substances and any drugs that are being sold, especially drugs that have ever been considered illegal in the United States of America. So this case shows that federal tax law has the final word in everything. And even if a business is perfectly legal, selling perfectly legal stuff, the IRS won't change its rules because your state changed their rules, and these companies that are going to sell these controlled substances must plan accordingly and must recognize that they are not going to get these tax breaks that other companies may be getting, and they will be in the end paying a lot more taxes. And so keeping those advertising and any other overhead costs lower is especially essential to these companies.
All right, moving into part 3 is going to be going over some authoritative sources which talk about some related tax topics. Um, First, we're going to look at what kinds of expenses actually qualify for the research and development tax credit and how companies can maximize those savings after the Tax Cuts and Jobs Act. Then we'll break down whether state level and angel investor tax credits help startups succeed or if they just flood the market with bad money. So let's get into these incentives and see if they actually work. And firstly, we're just going to be trying to understand qualifying expenses after the Tax Cuts and Jobs Act. And this comes from the CPA Journal. And this article analyzes how the TCJA affected the R&D tax credit, specifically with what now qualifies as a research expense. So just big picture, after the TCJA, it broadened the definition of a qualified research expense, or QRE for short. This makes it easier for startups and small businesses to benefit from the R&D tax credit. The first thing that's going to qualify now is wages, which includes salaries of employees who are directly involved in research and development. Not only engineers or scientists, but also supervisors and support staff may qualify if they directly contribute to R&D efforts. Next are supplies, and this refers to materials consumed during the R&D process. So if a startup builds a prototype and burns through their materials during testing, those costs still count and they qualify. Another eligible expenses are testing components, non-depreciable lab equipment, and contract research. If your business pays a third party to conduct qualified research, 65% of that cost can be included in your credit calculation, but only if the research is done in the U.S. and owned by your company. This expansion of eligibility is great news for startups that may not have a full in-house R&D team, but still innovate through contractors or early prototyping. Things that do not qualify are research that is done outside the U.S. That is ineligible. Another thing is routine data collection or quality control. That also does not qualify. Government-funded projects like research funded through grants are excluded. Capital expenditures like buildings or depreciable equipment are also not covered. So for businesses, it's critical that they distinguish between operational costs and qualified innovation expenses. And as we've said before, documentation is more important than ever, especially when dealing with the IRS. They've ramped up their scrutiny of R&D credit claims. To successfully claim the credit, you have to clearly prove the nexus or connection between your expenses and actual research activities. So good documentation includes things like time tracking logs, project descriptions, and progress reports. It can also be things like invoices or receipts that are directly tied to the tasks that the business is going through for research and development. So if the IRS audits your R&D claim and you can't show this connection with these documentations, they can and likely will deny your tax credit, which you do not want. So for businesses, there are some strategic planning tips that they can proactively use and to get these tax credits. One of them is to thoroughly review job roles to see if certain employees' time can be classified as a QRE, or they could also engage tax professionals early, especially when you're in the development or design phase of R&D. And lastly, they could use tools like time tracking software or cost segregation studies to cleanly separate research activity from general operations. And these tips are very important when dealing with the IRS because they are very detail oriented and they need to know everything about what goes into your R&D. So the takeaway is post TCJA, the rules have made the R&D tax credit much more accessible, especially for startups dealing with R&D. But with that becomes more responsibility because businesses need to understand what qualifies and document it properly and plan for it strategically if they want to take advantage of this powerful incentive. Next, we're going to be looking at angel investor tax credits, and do tax credits actually help startups? So this one doesn't directly go into startups, but it involves people that would be investing in them. And it's based on a study that analyzed angel investor tax credit programs across 31 states over the past couple decades. Now, these credits offer tax breaks to individuals who invest in early stage companies with the goal of encouraging more funding for startups. So what actually happened when these programs were introduced was states adopted angel investor tax credits. They saw a rise in both the number and size of angel deals. On the surface, that looks like a win, but more money going into more startups sounds like a healthy ecosystem. But when the researchers looked closer, some complications came about. The catch overall is that quantity does not exactly equal quality. While the volume of deals went up, the quality of outcomes did not. More funding flowed to less experienced founders, and many of the startups funded under these credit programs underperformed in the long run. The tax perks drew in a wave of inexperienced investors, sometimes called tourist or even newbie angels, who weren't always equipped to provide the strategic guidance that early stage companies really need. So, in other words, the tax credit may have distorted the market by making investing too attractive to the wrong kinds of investors. Instead of smart capital flowing to strong ideas, the incentives ended up diluting the quality of deals and spreading capital too thin across startups without the right support systems. For policy takeaways, overall, more deals didn't mean better outcomes. Simply increasing the funding isn't helpful to all the businesses if poor investment decisions are made. Design matters. If incentives aren't well targeted, they can create unintended consequences, like pulling in inexperienced investors who chase tax benefits more than long-term success with their investments. And lastly, states should reconsider or refine their approach. Rather than eliminating these credits entirely, the recommendation is to restructure them. For example, by adding like a vetting process for investors or tying credits to longer-term milestones. So just as a final thought, angel investor tax credits can help channel capital into startups. They're not a silver bullet. If they're not designed carefully, they can backfire, like drawing in the wrong capital, encouraging risky bets, and ultimately hurting the startups they were meant to help in the first place. This shows how critical it is to balance incentive structure with market strategy, especially when tax policy meets startup funding.
All right, final takeaways. Tax incentives, they reduce your financial pressure. You'll want to use them. Take advantage of them. Find out how they work. Hire an accountant. And use them to the best of your abilities and for your specific businesses. Learn the deductions and classify those correctly. Everything that you report it well. Classify it correctly, or else you may face penalties or just more expenses from not being able to deduct certain things. And it's important to learn them, document everything, and document it correctly, and understand the laws that apply to each of these codes.
All right, it's quiz time. You go ahead and take out your phone, scan the quiz, and there is a URL there if the QR doesn't work. But thank you guys for watching.
Thanks so much.
Patrick and I's presentation over tax incentives for business startups. Thank you.
Yep. Thank you. Have a good day.